It's a day for the financial market history books. A global market crash that saw markets from Wall Street to Asia to Europe tanking, deepening a rout that started last week. The biggest headline of the day came in from the Japanese Nikkei. That index crashed 12.5%, its worst fall since Wall Street's Black Monday of 1987. It wasn't just Japan. The South Korean Kospi plunged nearly 9%, the Taiwan weighted index collapsed about 8.3%, and markets in Singapore, Hong Kong and here in Mumbai fell, the tremors falling anywhere between 2 to 5%. So what happened? Well, they say that the only risk in a bull market is the one that you can't foresee. And that's exactly what has happened over the last couple of weeks. A resurgence of the possibility of the US going into recession, a hard landing as some call it. Let's look at the mother market. Wall Street has been on shaky wicket since the middle of July as macro data has started looking weaker than anticipated. The ISM manufacturing index for July is at an 8-month low, at 46.8 to be precise. A reading below 50 means contraction in activity. Both retail sales as well as consumer confidence numbers have been weak throughout May and June. The July jobs report released on Friday proved to be the straw that broke the camel's back. The pace at which the US added non-farm jobs was much lower than expectations, just 114,000 versus the 185,000 estimated. The unemployment rate is now soaring to a near 3-year high at 4.3%. The spate of weak data has led markets to question the Fed's stance of keeping interest rates high for so long and for potentially being behind the curve. In the last Fed meeting held at the end of July, Fed Chair Jerome Powell actually acknowledged that the central bank is ready to cut rates in September, but investors feel it may be too late. Given the panic over growth, some experts are now expecting the Fed to go on a reverse overdrive and deliver 100 basis points in rate cuts this calendar year itself. In fact, JP Morgan and Jefferies believe that the cuts could start coming immediately, well before the next Fed meeting, which is due on the 18th of September. So that's reason number one behind the panic, the possibility of a US recession. Now let's come to reason number two. The Japanese jolt is what I call it. As the Fed starts cutting interest rates, the Bank of Japan is actually hiking them as inflation is finally picking up in Japan. This is leading to the unwinding of the so-called yen carry trade, which basically involves investors borrowing in a cheap, low-yielding currency like the Japanese yen and then investing that money in higher-yielding assets around the world. Interest rates in Japan are now the highest that they have been since the global financial crisis of 2008. The BOJ didn't just hike the benchmark rate by 25 basis points in July. It is also looking at cutting down on the amount of bonds it buys from the market, which basically means that the Bank of Japan will not be pumping in as much money into the financial markets. The carry trade worked wonderfully well as long as the yen was weakening, which was the case up until July. But the BOJ rate hike has caused a dramatic reversal in the Japanese currency. In fact, it has surged about 10% versus the US dollar in the last 1 month alone, leading to plenty of trading mayhem as these carry trade bets start getting unwound. Now, the last issue, the third issue, which is compounding matters, is weak US tech earnings. The likes of Microsoft, Alphabet, Amazon and Intel have all reported uninspiring numbers in the June quarter, with Intel even announcing layoffs. This has slammed the brakes on the sizzling NVIDIA-led tech rally in the US. Investors are rushing to take profits, and the Nasdaq is now officially in correction mode, having lost 10% from the peak. So the question is, where does all this global mayhem, this roller coaster, leave India? For a market that has overcome all kinds of issues this year, including a slightly unexpected general election outcome and higher capital market taxes, the global sell-off presents yet another challenge to the resilience of the Indian retail investor. The Nifty has had a roaring 23% rally over the last 12 months, fueled by domestic liquidity along with, of course, surging mutual fund inflows. Experts say that this momentum is unlikely to reverse, though many, for instance, Invesco's Tahir Badshah, point out that the second half of the year may not be as smooth with respect to stock market returns.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.